This is Nightly Business Report with Sue Herrera and Bill Griffin.
Losses mount. The sell-off deepens after weak economic reports out of China spur a fresh round of selling. What did J&J know, and when did they know it? That's what investors are asking after a report says the company was aware for decades that its baby powder contained asbestos. Golf and the glass ceiling. Women are learning how to play the game so they can close more deals. Those stories and more tonight on Nightly Business Report for Friday, December 14th. Good evening, everyone, and welcome. Bill Griffith is off tonight. J&J lost about $40 billion in market value today. We'll have more on that in just a moment. But we begin tonight with the broad market sell-off. The three major indexes have all lost 10% or more from their most recent highs, meaning that they are all closed in the correction territory together for the first time since 2016. The concern is over global economic growth, which was triggered by weaker than expected economic data out of China. That sparked the selling, and by the close, the Dow Jones Industrial Average dropped 496 points to 24,100. That is its lowest close since May. The Nasdaq fell 159, and the S&P 500 slipped 50. So let's talk more about that sell-off tonight with Patrick Chovanec. He's the chief strategist with Silvercrest Asset Management. Patrick, welcome. It's a great night to have you here.
Hello.
So tell me what you make of today's move in particular. The volatility has been with us for some time now, but is the market overreacting?
So it's interesting, if you go back to the last three sell-offs before the latest one in October, all three of them were triggered by concerns about a slowing China. But I don't think that you can, and I've lived in China for a decade before I came back to New York, I don't think that you can draw a direct line between a slowing Chinese economy and a slowing U.S. economy. In fact, I think that the result is a slowing Chinese economy can be bad for some companies and sectors, but good for others in the United States. Okay. And I think each time it's taken the market in the past time to realize this and then rebound.
Are the fundamentals, though, for the U.S. economy and the companies that do business here and report their earnings, are those still intact?
The U.S. economy is slowing down a bit. It was really going strong last summer when the market thought that the U.S. economy could do no wrong. And now it's slowing down, and so people are focused on the downside. But for the life of me, I mean, I'm not a perma-bull. I'm not somebody who always cheers up the U.S. economy or the market and says it's always going in a straight line upwards. I keep on looking for signs of an imminent recession, and I don't see them. The latest economic data is actually relatively robust and relatively positive. There are things that could turn into bigger problems later, and there are soft spots. But I don't see the economy facing a recession right around the corner as the market seems to imply.
So very quickly, would you use days like this or the overall trend that we've been seeing of volatility and lower prices? If you're a longer-term investor, would you add to your positions? Do you find valuations compelling?
It depends on how long a term of investor is that you are and how much volatility or uncertainty you have a capacity for. I would say that somebody who is genuinely long-term, it is fairly attractive now, U.S. shares, compared to the alternative, which is still very low interest rates. But again, you have to be willing to accept the ups and downs of the market in the meantime.
Absolutely. Patrick, thank you so much. Patrick Chovanec with Silvercrest Asset Management. And now more on China and its weakening economy. Beijing is working to halt an economic slowdown, which comes as China grapples with the effects of the trade conflict with the U.S. That may be one of the reasons why China is temporarily slashing tariffs on U.S. auto imports. Eunice Yoon is in Beijing tonight.
China's finance ministry says it will suspend additional tariffs on U.S.-made cars and car parts. 211 items will be affected, with China lifting a 25% tariff on most of those items. The decision takes effect January 1st and lasts 3 months. The finance ministry posted an explanation on its website saying, "We hope the two sides, the U.S. and China, will intensify negotiations towards eliminating all tariff increases." Immediately after the announcement, Tesla cut prices on the Model S and Model X vehicles in China. Tesla is one of the few American car makers that exports whole cars to China. The announcement came after a raft of data showed the economy here slowing down even further. Both retail sales and industrial output missed expectations. Retail sales grew at their slowest pace since 2003. Industrial output expanded the least in nearly 3 years. Fixed asset investment jumped slightly, but only because it was so weak earlier in the year. Part of the slowdown has been engineered as the government cracks down on lending. However, trade tensions are weighing on consumer sentiment. China's Statistics Bureau said so far the impact from the trade war has been minimal, but the Bureau expects greater external uncertainties in 2019. That's raised questions here on what policymakers will do next. The central bank governor said Thursday that China would keep monetary policy loose for now. And next week, Beijing's leaders will meet for their annual economic policy setting meeting for the year ahead. Most analysts believe that the pressure will be on to stimulate growth even further as domestic demand continues to weaken and the clock ticks down on the tariff truce. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And now to our other big story tonight, Johnson & Johnson, and a product closely associated with that brand, Johnson's baby powder. For years, we've been reporting on lawsuits that allege the talcum powder causes cancer, something the company has denied. After every verdict, the stock barely budged, but that's not what happened today when Reuters reported that J&J knew for decades there was asbestos in the powder. The stock was slammed, it fell 10%, and that is its worst day since 2002. The stock's stunning drop followed a Reuters report based on that news organization's review of J&J company memos and other documents dating back to the early 1970s. In its report, Reuters says J&J execs, mine managers, scientists, doctors, and lawyers worried its raw talc and finished powders had, at times, tested positive for asbestos, but that they denied all claims until forced to share thousands of pages of internal reports with lawyers representing almost 12,000 plaintiffs who claimed that talc gave them cancer.
We see that historically in the 70s, 80s, that era, there were company memos and reports where they're talking about asbestos, what to do about it, fretting about it, how to detect it, how to get rid of it. Is there ever going to be a way that we can get rid of all contaminants? So during that era, they certainly were talking about it.
J&J disputes the validity of the Reuters report, calling it, quote, one-sided, false, and inflammatory. Simply put, the Reuters story is an absurd conspiracy theory, end quote. The company says its baby powder and other products are safe and asbestos-free. And Reuters reporter Lisa Girion told NBC News that J&J's testing has shown its products to be asbestos-free for at least 15 years. But the bigger problem for J&J may be the barrage of hits its reputation has taken this year. Trial juries have come down on both sides, some ordering the company to pay billions of dollars in damages, while others sided with the company. But all that publicity is now being compounded by questions of trust swirling around one of the world's biggest and best-known consumer health products brands. So does J&J's stock continue lower after today's drop? Joining us now is Damian Conover. He is the equity analyst at Morningstar. Damian, thank you so much for joining us tonight. What did you make, first of all, of the sell-off in the stock today?
Yeah, thanks for having me. Yeah, when we saw the major sell-off today, based on the news, it seemed like a major overreaction. To see this much market capitalization wiped out in one day relative to this legal threat, I think it was overdone. Now, we did think the stock price of J&J had gotten a little bit lofty, but that being said, we thought the reaction today was well overdone based on these legal threats that seem to have always been there, but just were elevated through this article that came out today.
You have a price target of $130 on the stock. Did today's action cause you to change that?
No, today's action didn't cause us to change our valuation. We've already accounted for a lot of legal charges for J&J, not only for this talc powder, but other cases that they have going on that are unrelated to this. And when we take that into account, we think the fair value is $130. So the pullback today, I think, put the stock basically where we think it's worth. But we don't think the stock price should have moved as much just based on this news.
Now, if this goes the way that other issues with the company have gone, we're going to see lawsuits, and you're going to see testimony and things, and you're going to see jury decisions. How is the stock, do you think, going to take that this time around, given the sell-off that we saw today?
You know, it's interesting. I've never seen J&J react this way to litigation concerns. So I think going forward, it will be a little bit more of a volatile name relative to how these different verdicts come out. But generally speaking, what we see not only with J&J, but some of these other major firms that have gone through massive legal suits over many years, is that the investment community focuses in every once in a while when there's a very inflammatory case or an inflammatory article. But after a while, they tend to get bored of the potential risk, and they pull back from damaging the stock because of those concerns, and you tend to see the stock to trade more on its fundamentals and less on legal concerns. And I think that is something that will very likely happen here with J&J. Again, over time, J&J will likely litigate case by case by case until a very long period down the road offer some settlement that will be probably not overly impactful to the overall valuation for J&J.
It's more the headline risk, right?
Yeah, I think that's what we're looking at right now.
All right, Damien, thank you so much. Damien Conover with Morningstar. So, indeed, how damaging is this latest revelation to the J&J brand? We're joined by Dean Crutchfield. He's the CEO at Dean Crutchfield and Partners. Welcome back, Dean. Nice to have you here.
Hey, Sue. Nice to be back. Nice to be back.
How damaging do you think this is?
Well, I think it's enormous. I think markets are emotional, not rational, and the big questions that companies often ask is this a close shave or a deep cut? And clearly, it's a deep cut. This is a major calamity for J&J. This is a brand that we all know and love. It's also a brand, as you clearly say, that has their name on the front of the pack. And it's one of the brands that defines who J&J are. Not so much for investors, but for the average consumer around the world. This is J&J, is its children's baby powder.
You know, they were the gold standard in handling a corporate crisis with the Tylenol scare years back. They seem to be, at least on the surface, denying this report by Reuters, and also the language that is being used seems different this time around.
Well, last time they had a tampered product, 3 people had died. It was 1982. We didn't have the media coverage that you get now. They handled it brilliantly. They took the product off the shelf. It cost them millions of dollars to do it, but they wanted their customer safe. They wanted their customer to feel confident. Here we have a situation where it's totally the opposite. That crisis is nothing like the one they've got here, because as you've said, they've been defensive. Typically, companies, when they face a crisis that they don't like, they depend, or they tend to defend themselves in an overly analytical manner, and they come up with lots of corporate legal puff. And I think if you look at the response, very much that's what we see right now. And I think it's on Gorski, the CEO's watch, to say, how do you really deal with this crisis? Because this is going to linger and it's going to continue. So this is where the throat to choke is the CEO, and we want to hear from him. The
language I thought was very interesting, the use of the word conspiracy theory. If you had to craft a message for them, what would it be? How should they go forward?
Well, they should look at their own vision statement. It's about people living healthier and better lives. So it's really about their consumer, and they need to be standing on the side of their consumer with the concerns that they have. So I think the kind of language is to respond boldly, respond with empathy, have some humanity. Don't send your lawyers after me. Send the CEO to me who can come up with something sensible to say, including the fact that you refute these claims. But I need to hear it from you.
And does this give an advantage, do you think, to other companies that are in kind of the same field? I mean, we did see their stocks go down today. Has J&J mishandled it to the point where it works to an advantage of the messaging of the other players in that particular field?
Absolutely. They're going to take a major hit on this brand, and people are going to walk away from it in their millions. So other competitors can clearly come in on here and take a position that depositions their brand and the reputation that they've got. I mean, there's 4 phases to a crisis program. There's the build-up, which has been going on for months now. There's the impact stage, which is today, losing $40 billion off your value. Then you have the chronic crisis stage, and we haven't even seen that yet. That's going to be happening next week and the following weeks, where the media and the gosh and the horror and the probe is going to unleash itself. And what J&J wants is, when is the resolution phase? And does that mean Gorski steps down? There's my question.
Well, that's a question that will be answered, I guess, in time, and we'll probably be talking to you about that. Thanks, Dean, very much. Dean Crutchfield with Dean Crutchfield and Partners. Meantime, investors today brushed off relatively strong economic reports, including retail sales, which rose at the start of the holiday shopping season. Sales increased 0.2% in November, exceeding expectations. Economists say consumers are feeling good about their job prospects, and that is helping lift spending. A separate report showed a 0.6% rise in industrial production, which also exceeded expectations and was the strongest gain in 3 months. And now to Europe, where British Prime Minister Theresa May spent the 2-day summit of European leaders looking for some concessions on the Brexit deal. But in the end, she didn't get it. And EU leaders said their divorce agreement was final.
The Union stands by this agreement and intends to proceed with its ratification. It is not open for renegotiation.
As we've been reporting, it's been a turbulent week for Prime Minister May. She survived a no-confidence vote on her leadership after she postponed the final parliamentary vote on her Brexit deal. Time to take a look at some of today's upgrades and downgrades. Cisco was downgraded to neutral from buy at Instinet. The analyst there says IT spending may start to soften in the new year. The price target is $50. The stock fell about 3.5% to $45.82. Walgreens' rating was cut to sell from neutral at Goldman Sachs. The analyst says challenges in its pharmacy business have intensified. The price target is $68. The stock fell more than 4% to finish at $78.74. Procter & Gamble was upgraded to overweight from equal weight at Morgan Stanley. And basically, the analyst there cites an improving outlook for gross margins. The price target is $106, and the stock was a bright spot in today's market. It rose just a fraction. It finished at $96.64. Still ahead, our market monitor is finding some bargains in this sell-off, and he is naming names coming up next. In Washington tonight, President Trump has picked Mick Mulvaney to be his acting chief of staff. Mulvaney is currently the White House budget director. He will replace John Kelly in the new year. Well, today's stock market losses wiped out the gains for the week. All 3 major indexes were lower, and the selling caused investors to pull money from U.S. mutual funds and ETFs at a record pace. According to Lipper, more than $46 billion was redeemed last week, the largest weekly outflow since it started tracking inflows and outflows. Which brings us to our weekly market monitor. He has some names of companies he says investors need to get into. They're getting for a great price in this market, and they're names that you're going to want to own over the next year. Joining us is Hank Smith, Chief Investment Officer of Equities at Haverford Investments. Hank, welcome. Nice to have you here.
Good evening, Sue. Good to be with you.
You picked some large-scale names here in a very diverse field. So let's start basically with your first one. It's Dow DuPont. Why do you like it?
Right. Well, first of all, if you don't believe that there is going to be a recession, you've had this big sell-off in a lot of the cyclical names like Dow DuPont. And we think this company is extremely well positioned. They're going to be splitting into 3 different companies this spring. The history of spin-offs is a very positive one. They've taken $3.5 billion of cost out of the company prior to the spins. All spins will be investment grade. They'll all pay a dividend. And I think this sell-off that we've seen in the past 5 months in Dow DuPont represents a real opportunity, particularly with our forecast of no recession in 19 or 20.
Okay. Next, you have a stock that you call best in class, and that is JP Morgan.
Right. Well, look, it is the highest quality bank in the world. It has a fortress-like balance sheet, and it is returning money to shareholders in both share buybacks and big, significant dividend increases. And so, again, if you don't believe there's a recession, this 20% pullback in JP Morgan is a wonderful opportunity at a very attractive valuation of under 10 times earnings.
And we're going to finish up with Apple. The stock has been hit quite hard, and it's in bear market territory, but you think it's also kind of a best-in-class stock.
Oh, absolutely. It's one of the greatest brands ever created. And look, Apple's stock price has a history of these kinds of significant corrections, bear markets, as you correctly pointed out, both in 12 and 13, and then again in 15, 16. So it's had a major run up, a big pullback. It's probably been overdone, but for any new money coming in, you know, you're buying one of the great brands at a below market multiple, and again, a company that has prodigious amounts of cash to buy back stock and increase dividends.
All right, on that note, Hank, thanks so much. Hank Smith with Haverford Investments, and to read more about his stock picks, head to our website, nbr.com. A Dow component is paying you back, and that's where we begin tonight's market focus. Pfizer hiked its dividend by about 6%. The drug maker also approved a new $10 billion share buyback program, and that, of course, is in addition to the nearly $5 billion remaining under the company's current plan. The stock, though, fell more than 1.5% to $43.80. Nucor is forecasting 2018 profit above analyst estimates. The largest U.S. steel producer expects strong demand and higher average prices next year, and that lifted the stock more than 1% to $56.39. Starbucks issued a conservative growth forecast. The world's biggest coffee chain also said same-store sales growth would remain steady over the long term, even as it expands delivery options and expands in China.
We are growing in China in the mid-teens, and we outlined that China right now is in a different stage of market development than the U.S. China is all about store expansion, new unit growth, so that we can create a first-mover advantage and establish the Starbucks brand in more points of presence in cities that we're in and in more cities that we're not in.
Starbucks shares finished down 2% to $65.34. Endo International's shares fell ahead of a 60 Minutes report on the opioid crisis. The report focuses on data collected by opioid distributors on amounts and destinations of painkillers. Attorneys are planning to use that data against opioid distributors like Endo, and that sent its shares lower by more than 8.5% to $10.19. Coming up, women are taking a swing.
I'm Jane Wells at Westlake Golf Club in Westlake Village, California, where women executives are trying to break the glass ceiling with a little white ball.
General Motors is offering some details on its restructuring plan. The automaker said that most of the 3,300 factory workers slated to lose their jobs will be able to find employment at other factories. That does mean, however, that some employees will have to relocate. GM still plans to lay off about 8,000 white-collar workers and another 2,600 factory workers in Canada. Well, the golf course has always been thought of as a place where business relationships are formed and where deals are done. But the sport is still very much dominated by men, leaving little room for women to climb that corporate ladder. So that's why one female former pro golfer is making it her mission to get more women executives involved in that game. Jane Wells is in Westlake Village, California.
A group of women executives in Southern California is trying to move forward.
I at least hit the ball.
A new law in the Golden State mandates that the more than 400 publicly traded companies based here have at least one female board member. But a lot of women CEOs, CFOs, CIOs, whatevers realize you don't get positions like that just from your resume, but from relationships.
A lot of people golf in business, and I just felt it was important to do. And it's actually kind of fun. I really enjoy it. Oh, God, that was so good. Yeah.
Deb Richard is a former LPGA Tour player who's been brought in by local sponsors to teach this wonderful, frustrating, addictive game to women executives.
If I do quick math, I've played with about 2,000 amateurs just in LPGA-sponsored Pro-Ams. I played with about 10 women. And so I spent all of my career helping men build relationships that advance their careers. I want to do that for women.
Golf makes you vulnerable, and it also teaches you a lot about a potential client or employee while you're out on the course. For example, you know, do they cut corners, or how do they handle disappointment?
You get to learn about their frustration level, what sets them off, and, you know, are they really tightly wound?
But a funny thing has happened in this group. These women may have gone into the program to learn a new way to network with men. Instead, they're starting to network with each other.
Because I know that you're communicating with each other and getting together outside of these events, and nothing makes me happier than that.
One report over the last 20 years says golfing CEOs make 17% more money. So perhaps these women are not just learning to drive for show, but to truly putt for dough. For Nightly Business Report, Jane Wells, Westlake Village, California.
And before we go, here's a look at the final sell-off numbers on Wall Street. The Dow fell 496 points to 24,100. The Nasdaq was off 159, and the S&P 500 was down 50. For the week, all of the major indexes were lower. And that does it for Nightly Business Report tonight. I'm Sue Herrera. Thanks for joining us. Have a great weekend. We will see you on Monday.